So you might be wondering, what is Lemonade worth? What is the value of Lemonade stock? And after the recent surge in price, went from $16, even as low as $14, all the way up to $22, $23, $24, is it still worth buying? What should Lemonade be valued at now? We're going to try and answer those questions in this video.
At $18 as it was, or $16 or $7, whatever it is, by most measures, I think the share price should be at about 4 or 5 times that today, just by looking at gross profit multiples.
That was Daniel talking about why Lemonade could be worth easily 4 or 5 times what it is now, at least in his opinion. I'm going to try and back some of those numbers up at least a little bit. But first, to give a little more background, my thoughts on valuations, on discounted cash flows, let's listen to Warren and Charlie.
I've never seen, Warren talks about these discounted cash flows. I've never seen him do one. If it isn't blue perfect obvious that it's going to work out well if you do the calculation, he tends to go on to the next idea.
Yeah, it's sort of it is true. You don't if you have to actually do it with pencil and paper, it's too close to think about. I mean, it ought to just kind of scream at you that you've got this huge margin of safety.
This is how I feel about a lot of investments in general, is that, you know what, people get hung up on all kinds of details. Even though they're making massive, huge assumptions, people get tied up on the most finite details. It's like they're measuring something to like a nanometer, but then in the end, you're cutting it with a chainsaw. It doesn't make any sense. You just have to understand, at least from the basic principles, does this make sense? Can you quantify this? If you can quantify that, if you can make sense of that, that's all you really need as investors. So like Warren said, it should be a slam dunk. It should be a huge margin of safety. So in Lemonade's case, I put together this simple valuation model. This is part of my larger Lemonade model. It's got a lot of details, a lot of graphs. I use this in a lot of my videos, and its full model is available to my Patreon members. So thanks so much to everyone who's supporting me there. We're going to walk through this valuation model, a bit of a separate model on its own that you can easily play and figure with some of the assumptions, which we'll do here in a moment, and see sort of what kind of present value, what kind of market cap are we going into the future, what kind of operating profit might we see. So on the left here, I'll explain it here just so we're all on the same page. I have years from right now, 2024, all the way out to 2039, even 2040, partially showing there, and marking that as a year zero onwards into the future. In-force premium, currently the company, maybe this quarter we're going to be around, so sort of mid, 2024, halfway through, probably around 850 million IFP, which I've set over here, in-force premium now at the start, 850 million. And then I have a in-force premium growth rate right here, 25%. So you have that growth rate compounding for the premium indefinitely out for the next 15 years. Now, of course, we made a huge assumption right there. If you're looking at this model, can you say, well, can they really grow 25%? Can they really do that for the next 10 years, 15 years? I think it's conceivable for sure the next 10 years. You think out to 2034, you're talking about 7-8 billion in in-force premium. To me, it seems very, very reasonable, even beyond in a 20 further out, maybe by the end of the 2030s, they're at 24, 25 billion in-force premium if they just grow 25% year over year. I think they're built to rapidly scale if the unit economics make sense. So I don't think that's a crazy assumption. All along through this model, what I want to point out is that we're trying to challenge our own assumptions. Does this assumption make sense? Is 25% conceivable? And this is simple, right? This is like one growth number that applies for the whole next, 15 years that we're showing. Maybe the next 5 years, we can be super certain that they can grow 25%. Maybe the next 10 years, we're quite certain. Maybe 15 years, we're a little less certain, but still possible. Maybe they could even do much higher than that. Maybe they do 30% for the next 10 years, and then it slows down to 25%. So you just have to always be thinking about each assumption we're putting into this model. And if you can confidently understand, explain, know each assumption, and the math makes sense at the end, in my mind, that's a slam dunk. So then we get to gross profit. Gross profit, we're not factoring in reinsurance effects. We're keeping that, again, quite simple model. And it's gross loss ratio, I'm saying, we have a loss ratio of 75%. So 1 minus that times by your in-force premium will be your gross profit. Guys, that 75% I'm keeping as an average. Obviously, there might be years where it's 60% and there's years where it might be 90%. But as a sort of smooth curve for an insurance company, 75% I'm saying right now. Of course, we'll play with some of these numbers here in a minute, but 75% is what I'm going with. Now, operating expenses, I've split them into CAC expenses, which are only related to customer acquisition. That's different than what Lemonade lists as their sales and marketing, because Lemonade has sales and marketing. And if you flip over to my model, you'll see it right here. So they have sales and marketing as a total line item. You'll see that in their, their quarterly reports. But then they have sales and marketing as a fixed, what I'm calling fixed, and then sales and marketing variable. And sales and marketing fixed is kind of all your overhead costs, your main department costs. It should be relatively fixed and should have a large amount of operating leverage on those line items. They shouldn't grow too quickly relative to as the book grows. Sales and marketing CAC spend is, hey, what's the advertising money you're spending to drive new sales, new customer growth? So that as you scale, that value is going to scale. That's why I broke that out. These two numbers, I separated the two back here in the valuation model. So we have CAC spend as the main sort of factor, which is a function of how quickly the in-force premium is going to grow. And then operating expenses minus CAC is what I'm showing here is, everything else. So all the rest of it, we're at around, it's approximately 370 million right now. And the CAC, this year, we'll look at CAC in a moment. But operating expenses minus CAC, with that not included, I have again here a starting rate of 370 million over in the variables, and then a growth rate of 5%. So that grows out 5% every year. I'm saying, it's been very flat for the last few years. In fact, if you look at this graph that's been being shared on Twitter, I posted this, I don't know, maybe a few weeks ago, and it shows in-force premium, how it's really scaled up, even though the last several years, operating expenses, and this even includes your CAC spend, customer acquisition spend, it stayed very, very flat. So in my, simple valuation model here, to say it's going to grow 5% a year, I think that's a reasonable assumption. Again, here's an assumption we're making. I think that's a reasonable assumption. Maybe it's higher, maybe it's lower. We'll play with those numbers, but then that shows, hey, that 5% growth scales out. You're talking it by 2034, 10 years from now, you have almost $8 billion of in-force premium, and you have $732 million of 600 million of operating expenses except for CAC. And then CAC, your customer acquisition spend. So how am I calculating that? I'm looking at, hey, first of all, C3 minus C2, that's how much in-force premium do you gain from this year until next year? So in that case, it's 213 million. And then how much premium of this year's premium did you lose just from churn? So that's going to be your 850 million times by 1 minus 88%, which is your annual dollar retention. So that's how much dollars, that's a number Lemonade releases. It was about 88% last quarter. I expect it will continue to be about 88% or even get better in the future. So I'm putting 88% in, and then it applies to all these years going forward. So, but that works out to, you have the difference in premium, which is 213 million, and then you overcame another 102 million that was lost through customers churning. Right? So then together you have 315 million, and I'm dividing all that by this rate of 4, which is your IFP to CAC ratio. That just shows how much premium are you getting for every dollar of customer acquisition that you spend. So Lemonade in the past has said it's 3, and then I think it's actually moving to 4, and I actually think it will move higher. Here's what the IFP to CAC spend has been the last few quarters. So 3.5, 4, 4.7, 4.3, and here's what I'm kind of, roughly predicting from my main model, that this overall trend will continue to scale up. Eventually it will be 5, 6, 7, 8, and it's not because, hey, their marketing got magically more effective, although it might become more effective as they hone things in more and more. But the reason this is going to grow is because there's more and more cross-selling of customers. So you look at the whole book of business and you say, how much premium did you gain? you gain so much more. Well, a big chunk of what you're gaining is just current existing customers that stick around and now are buying more products and bigger products. So that's why I think this number will actually continue to scale up and go higher and higher, is sort of my prediction. And so far, that has been the correct prediction, the way it's trended. It went from 2.5 to 3 to 4. But I'm putting in 4, and that 4 is just going to continue statically forward for the rest of the model to calculate your CAC spend, even though, maybe you could say, in the future it's going to be 6, and you change that to 6. Well, now that drops your CAC spend significantly. I'll just switch that back though to 4 for now, and you get to that range there. So then, just for reference sake, for our own sanity check, I have an expense ratio. We're at 53% now, which that's checks out with what we're at, and then by the end of 2030s, I'm at maybe 12%, depending on how fast this grows and depending on how the top line grows, right? And depending on the marketing efficiency. So that squares all that away. You get your operating profit simply by taking your gross profit minus your operating profit or operating expenses. And then, you get down to... It's a break-even point here of like 2029, 2030. I think that will come sooner because some of these metrics, the growth, and I think this 5% OPEX, minus CAC growth rate will be less. And I think actually this number, this 4, will be more significant, especially like next year, 2025, 2026, as car really scales up through the existing customer fleet. So I think actually some of these numbers are a little bit pessimistic, which is why still the profitability is coming later, but still good for a valuation kind of long-term trend, because then you get to see with the current, those inputs we have, by 2035, say you're at almost your $900 million operating profit. End of the 2030s, a few years later, you're at a $3 billion operating profit. And show an operating margin here, just so you see, it flips there, and then you get to about maybe 13% operating margin even by that case, assuming you can continue to scale that. If you think about it, they have 24 billion IFP, 6 billion gross profit, 700 million of expenses, and they spend 2 billion on customer growth, because you have massive amount of growth to be really pushing these numbers. But you assume again that you have big, huge amounts of customers that are cross-selling. You're in more and more countries, more and more geographies, selling more products to so many people. So that's how you get to sort of that scenario where, hey, it's 13% and you're making $3 billion of operating profit. And this shows, at least on the positive side, how much operating profit is growing. So you see it's at a very small base here in this model, and then it's growing like 7-fold, 692%, 130, and then it, that slows down a bit it gets closer to your overall kind of top line growth rate, but the profit really skyrockets there for a while. And then I put in a PE to operating profit. Again, keeping this simpler. I don't have taxes. I don't have any other depreciation, anything like that in there. Keeping this quite simple. I'm scaling down. You can put in any PE number you want if you're playing with this and copied out throughout, but I started with 60, and then I'm diminishing that by 10% each time. So it's finishing down to, by 2039, 21 ratio PE to operating profit, even though they still maybe are growing pretty significantly, so could be worth even a lot more at that time. And then you get a market cap from that, just using your PE, your operating profit, and that PE ratio. So somewhere between, by 2030, you're at, in this scenario, you're at 16 billion, 2033, that is 16 billion. And so on and so forth, all the way up to 40, 50, 60 billion by the end there. And then I have shares. So we're at about 70 million shares. This would be millions of shares right here. And then I have a share dilution rate. So I put in 1%, which is, I think, around what we've been at for the last little while. So that's how much dilution they have in their shares. So each year is growing at about 1%. You maybe, in the 2030s, we have 80 million shares instead of 70 million, right? And then this gives you your share price, your market cap, and your number of shares. It's showing sort of a projected share price based on what you're making, based on these PE numbers. Now, I don't think it's going to be worth $11 a share and then suddenly go to 400. There's going to be more of a scale here. Maybe they'll have not a 54 PE, but maybe it's like 1,000 PE and it's worth 200 or something like that, because you're flipping to positive and the amount of earnings you have are so small, but the amount you can grow based on those earnings is so big. So your PE number is going to be really, really big, right? So yeah, so you get a share price that's somewhere in there. And then finally, I have a present value based on what that share price could be. So that's just discounted back from based on the number of years. And I have a discount rate. Right now, I have in there 15%. And that says, hey, that future share price that says it's worth 3-year $295 in 2034, 10 years from now, what is that worth today with all these inputs? Based on a 15% discount rate, just means that, hey, it's worth $73 a share right now would be the present value. And each one of these is a little different because what year are you projecting out? So it just shows the present value based on each one of these years. So it's a nice spread. It shows that graph right here based on these PEs, all these inputs. You have kind of a distribution of what the present value would be. And if you take something in the middle, you're at around like $90 per share would be sort of a fair value for what Lemonade could be worth right now. But now you start to play with that. You say, well, maybe the discount rate should only be 10%. So instead of 15%, it's only worth 10%. And if you don't understand discount rate, it's basically like, hey, if I paid $114 right now for the instead of $20 a share, whatever the price is, instead if I paid $114, that would mean if I made 10% a year still on my $114, so still a good return, 10%, decent return at least, all the way out into the year 2034, and then it still, it still would get to this share price of $295 at that over that many years. So yeah, if you switch to 10%, well, now you're suddenly at like a fair value of $130, $140 a share. Let's flip it back to 15 though and play with these some of these other numbers. So maybe you say the loss ratio just never quite get as good and there's more natural disasters, so maybe we bump that to 80%. Well, now that suddenly flipped, it still says present value should be somewhere in the $40 to $50 range, something like that. It depends how much you play with these PE ratios. That can really affect it, but gives you some idea. Hey, maybe it's worth $40-$50 a share, even in that scenario. I think they'll get lower. I think they'll get to the 75%, but say that's the case. Maybe let's be really pessimistic. Maybe they grow only 20% a year with 80%. And so you're still like, well, then the fair value is closer to reality. So if you think you're more pessimistic and you're like, yeah, they're only going to grow 20% sort of indefinitely into the future, it takes longer to become profitable, and you only get to that amount, right? But and maybe you think IFP to CAC. I will just keep making this really pessimistic, and then we'll switch it back to the more optimistic, which I think in my mind is more realistic. Say IFP to CAC is only 3. Well, then you actually, maybe the value is only like worth $10 a share. Really not great, but I don't think these numbers are realistic. I think they're going to grow more than 20%. I think IFP to CAC, I know, has been over 4, and I really believe will continue to scale higher. Annual dollar retention, shares, these are pretty set. Maybe annual dollar retention I don't think you see it getting worse. So I don't even know how we could sort of make a pessimistic case that would get any worse. But it's even these pretty pessimistic numbers, we're still like, maybe it's in the teens, at least somewhere in that range. Now, let's go make it more optimistic. So let's start back to where we were, 75%. And let's say 25% there. And let's say 4 on this guy, IFP to CAC of 4. Now, let's say the IFP grows, 30%. Well, now suddenly you're at, again, like that $150 a range sort of scenario, maybe lower, somewhere in like even 80, 90, 100 up to 150. It would be sort of a fair value. Maybe the IFP to CAC, though, let's say like this averages out to more like 5, especially in the future years with all that bundling. Well, now it's like more of these are pushed higher and say, the present value is like easily, you can argue it's $150 a share. Like that would actually be a pretty good return. You still get 15%. Maybe the discount rate, 15% is too high. Let's go 12. You say like, well, actually like a fair value could be $200 a share. It's like 10 times what it's worth right now. and you still get a you still get a 12% return even if you pay $200 a share out into the future over the next decade. So, it's not so bad anymore. Yes, if we go really hyper growth, I mean, the loss ratio is going to really affect it. If you go, say they get to an average of 70 and they get like a lot of customers, which is not unreasonable. They could have worse years, but maybe they have other years where they're like 60% and other years where they're 80%. And they grow 30%, and this day they grows at 5, and that's 5x, 5P to CAC. And yeah, that 12% discount rate. Well, now this is like hyper bullish, and you're like, yeah, you could pay $200-$300 a share, and you're still getting a good deal, and you're still getting 12%. So this is what I'm talking about. In my mind, the margin of safety on Lemonade is huge. So if my kind of base case, I would do something like we started with, probably 75%. I know the company's targeted that value in the past, and will they actually, achieve that or not, or maybe even do better than that? I think if anything, they'll get there and potentially even do better than that. But put 75% in as that, and then I don't know. I think 25% is reasonable. Companies, or they've been sort of forecasting or saying that, but they've shown hints that they could go 30-40%, so they might grow faster in closer years. Like say if you punch in 40, the numbers get nuts. You're like, oh yeah, it's worth anywhere from $100 to $400, $500, $600, $700 a share. And this partly depends on huge effect is what PE ratio do you put in here, right? So we'll change this back though from 40% back to 25%. And this maybe you think the OpEx, is going to grow faster. So maybe that's 10%. Well, it's still worth, $90, $100, 80, 60, 70, 90 present value. Even that scenario, even if OpEx minus CAC is all your other operating expenses, they don't have quite as much operating leverage as we would have hoped. You're growing 25%, but you're growing 10% here. But I think that, for 25% growth and 5%, I think that's a reasonable ratio. They're really, really hyper focused on cutting out waste and making processes as value driven as possible with as minimal sort of effort as possible and waste as possible. So I think they'll have a lot of operating leverage, continue to see that, right? And I would say, yeah, I don't know, maybe 4.5 for this value. I think this will go higher, 6, 7, 8. Like if you put in 8, the number is going to get nutty. It just jumps up there. But let's go, back to sort of a best base case we can come up with, 4.5. Annual dollar retention, yeah, you could bump that up to 90. It's going to just improve it, but let's keep it at 88 because that's what we have. And yeah, discount rate, I don't know. I think maybe we'll leave that at 12%. As a discount rate. And, then you're in, depending here, $100 a share plus, to me, is still a reasonable present value. That's why at some point, I think you'll have this rocket ship moment where Lemonade's like, the market's like, well, yeah, I understand this. They're going to keep growing 25, 30, 40%, and their operating expenses are going to just barely keep creeping along, not going to have much growth in there, and they're converting their customer acquisition to premiums at a very good clip. You put those things together, it's like, yep, the present value of the future cash flows or future value is somewhere like a multiple higher than we are right now. Even at 20, even if the stock has surged to $23 a share. In my mind, I'm like, that's great. I'm still buying shares. I literally bought shares yesterday or today at 20. This is on the 18th, July 18th. I'm filming this, and I literally bought shares at like $22 a share. And I bought them at $14 a share, and I bought them at $10 a share, and I bought them everywhere in between. As I have money, I just keep buying shares. It's really, my strategy is pretty simple. That's at least my strategy. So, because I really believe this. I think this is what the present value could be, and it's like Warren said in that little clip we watched. It should be like slapping you in the face. It's so obvious, and to me, it is that obvious. Like they should easily get 25% growth rate for the next 10 years. I believe that. And they should be able to just barely have, OpEx should just grow slowly. and their IFP to CAC should be at least 4 or 5. Even like I showed you on the other graph, I think it'll go 6, 7, 8 kind of. It'll go quite high as existing customers, that pool grows, and they have more opportunities to bundle much higher value products. So in my mind, all these assumptions are really, really solid, and you're still getting a present value of like over $100. So it's really, really wild. Now, one thing we haven't played with here in this base case is the PE. So I had it as a sort of diminishing PE, like 90%. But if we just put in, I don't know, we put in like 50, put in some static numbers, you can see then the present value is going to be somewhere in this range. Maybe it's $300 a share, maybe it's $115 a share. It's very, if you thought they're still getting a PE of 50 by the 2039s. Now, I think I don't know if that would be realistic. You never know. Let's say it's 30, right? Let's just make PE 30. And then again, you're still above 100. Like, no matter whichever way you slice it, even if you go 20x, you're still in like 60, 70, 80, 90 with these assumptions right here. Like, it's really I cannot stress this enough. The margin of safety in my mind is just massive. That's why I just keep buying. I bought shares at 20, even after this surge, and people are like, maybe it's going to fall down, maybe it's going to do this, maybe it's going to do that. To me, it doesn't matter. I bought more shares. In fact, even if it skyrockets to like 40, 50, 60, and like after earnings, that's great. We had the rocket ship moment. That's freaking awesome. It truly happened. I'll be pumped. But if they flip after earnings and it drops down to like $14, $15 a share, I know these assumptions in my mind are really, really solid. The present value is worth something like $100 a share, 80, 90, 100, 120, whatever it is. And so I'm going to keep buying. And if that happens and it drops back to like 14, I'm just going to happily keep buying, because there's cash flows in my life that every so often you get paid, and then I can use those funds to buy more shares. So I have more time to buy more shares, more time to buy more shares. That's my whole strategy. Tipping my whole hand here. Tipping my whole hand. It's a real simple strategy. That's all I do. So that's what I'm doing. This is the math. This is how I've worked it out. Let me know what you think, Lemonades, of this whole model, this way we did this, and what you think about what their present value and sort of fair value right now would be. Thank you so much for watching, and remember, it's in the bag.